started with some housekeeping items, and then we will jump into our content today. So, as a bit of a introduction, welcome all to our webinar today on Basel III Endgame, hosted by Suade. I'll get into kind of main housekeeping. We believe this will be about a 30-minute, half-hour session. We are recording this. So if you do need to exit for any reason, we will have this posted at a later date. We do recommend staying until the end. We will have some poll questions at the end, actually. I think those will be interesting for you all to see, where the rest of the audience stands, where your industry and your peers stand. So yeah, now that we are a few minutes after the hour, I'll go ahead and introduce myself and our lovely panelists. So hi, I'll be your moderator. I'm Nina Enholm. I'm a senior customer success engineer here at Suade. I work with our clients automating and submitting reports to various regulators in the EU, in the UK, in the US, and more. Before my time at Suade, I spent years in financial reporting technology, specifically in the US markets. So great to be kind of holding a webinar for that space again. We also have with me Kira Snow. She's a senior implementation specialist here at Suade. Kira specializes in global regulator compliance and automation. Kira brings over 2 decades of experience in the banking industry, specializing in large-scale regulatory change. We also have Andrea Haskell. Andrea is a partner at Deloitte in banking and capital markets. Andrea has spent 2 decades in financial consulting. She also has an MBA in economics from Booth. We're very lucky to have both of them here, kind of to speak on Basel III Endgame today. I will probably, based on your backgrounds, Kira, I'll likely start with you and kind of have you walk the audience through a bit of what Endgame is, kind of how we got here, where we're going, and then Andrea, I'll turn it to you for more of a how are you seeing this anticipation and the reception kind of play out in American institutions. Um, so with that, Kira, I'll turn the first question to you. Let's really start at the beginning. For anyone less familiar, what do we really mean by Basel III Endgame?
Great. Okay. Well, hi, everybody, and thank you for having me. It's a great opportunity to talk about a topic that's really high up on the agenda, both in the US, but also on the other side of the Atlantic too. So, in order to set the scene, Basel III Endgame is the term used for the US implementation of the Basel III reforms. It's really that final piece of the puzzle and specifically focuses on capital and the calculation of capital to cover an institution's risks, so credit risk, market risk, CVA risk, etc. It's worth noting that while Basel Endgame sounds very dramatic and it's by far the best naming convention across the globe, um, a lot of the Basel III reforms are already in place in the US. It's very much part of the regulatory landscape already. So the US market isn't new to Basel III. What's new is this final piece, so this end game which covers the capital elements. So the first step in the journey was, so in July 2023, the US regulators jointly released a long anticipated Notice of Proposed Rulemaking, so an NPR. And that really laid out how they intended to implement Basel III Endgame. And that was really that first step on this journey.
No, great point. And I guess follow up on that is those proposals drew quite a bit of attention and even a bit of criticism. Can you kind of elaborate on why they were controversial, really what they included there?
Sure. So the proposal from 2023 was very ambitious. It really made banks rethink how they look at regulatory capital. One of the big things that happened in this proposal was some of the smaller and mid-sized banks, so the regional mid-sized banks, category 3 and 4, were brought in under the Basel III reforms. So we really saw some of these more stringent rules applied to a wider group. At its core, the proposal stayed quite true to the Basel framework. It looked to standardise how banks calculate their risk-weighted assets. The idea was moving away from the reliance on internal models and looking at standardised approaches, and ultimately just reducing volatility in capital calculations in the market. I could talk about the changes in that proposal. I think I'd need a whole webinar to cover everything. So, some of the highlights were there was a big change for accumulated other comprehensive income. Um, and the change was that that would then flow into capital, and that could really increase capital in a rate volatile market. The another kind of key change that got a lot of press was the output floor. So there was an introduction of the output floor, and that capped the benefit that firms can get from using internal models relative to the standardized approach at the famous 72.5%, which we've all come to know and love. We also saw increased risk weights. And for some of the key portfolios, the really material portfolios, so for example, residential real estate, we saw a real increase in risk-weighted assets there as well. So many people viewed that this proposal had actually gone further than perhaps other jurisdictions or the intended kind of the vanilla version of Basel, for want of a better term. And the term gold plating was used a lot. So the standards were seen to be much more stringent and much more conservative than people were expecting. Some banks, some of the large banks, estimated an increase in capital of around 20%, which is obviously a huge impact to them. So, unsurprisingly, there was a lot of pushback from both industry groups. There was a lot of press on the subject as well. And I think the term unprecedented was used for the amount of feedback that the regulators received on this proposal. So, really, just to talk about some of those critiques and some of the challenges that banks put forward to the regulators, I'm going to kind of cover those under like three categories. So, first of all, and probably the obvious one, is those increased capital levels. So, a lot of critique, critics of Basel Endgame said that US banks are already well capitalised, and increasing that even marginally could limit credit availability in the market and hamper economic growth. They didn't feel that that was really necessary. There was also a lot of concern around competitiveness. So both on a geographical standpoint, so if the US gold plate their standards, are then they going to be put at a disadvantage to some other jurisdictions where perhaps they're not as stringent? And then also domestically, so potentially large banks could be at a disadvantage to perhaps non-banks, and financing activity could shift that way. So there was a real concern there.
Yeah.
And then really finally was the operational concerns. So firstly, again, for those smaller and mid-sized banks that got pulled into the standards, there'd be a lot of implementation for them, and also the ongoing capital calculations are complex. So there's that ongoing complexity. But also there was increased regulatory reporting and disclosure requirements. So there was concern again around kind of that regulatory spend and just those and some of those burdensome regulatory requirements there. So overall, sorry, I know I've spoken for a long time. So overall, the message was quite consistent. They wanted the regulators to slow down and take another look at the approach.
No, that makes sense. And that was all kind of speaking to what we had seen in 2023. So, Andrea, I promise I'll get to you, but here, wrapping this up, where do we really sit today? What was kind of the regulators' response to a lot of that feedback? Kind of what happened next? Bring us up to today.
Yeah, so to kind of finish the picture almost of where we are, after the feedback that the regulators received from the industry, they really did hit pause. It was a bit of a reset moment for Basel Endgame, and it was a significant shift. The regulators wanted to take more time to analyse data, really understand what was happening and the impact on regulatory capital. So actually, in September 2024, there was a speech at the Fed from the then vice chair, sorry, of supervision, Michael Barr, and he acknowledged that material and broad changes were required in the standards. So I think the regulators really took it on board, and understood the bank's concerns. This did, just worth pointing out very quickly, that it did have a domino effect internationally. So we really saw this pause ripple across the Atlantic, and we saw the the UK and the EU delay aspects of their Basel III implementation. So it was a real turning point for Basel actually globally. So it was interesting.
Yeah.
So moving on to 2025, sorry, so moving on to where we are now, we've seen a broader policy shift in Washington and the current administration emphasising on reducing regulatory red tape. So we've got a different political landscape as well. Um, at the Fed, Vice President, said it again, sorry, Vice Chair of Supervision, now Michelle Bowman, has also echoed that proportionality is required. She also is focusing on the fact that the new capital requirements need to be viewed in a more holistic way. So it needs to be reviewed in the context of the whole regulatory framework. So there is a lot of work to do there. Um, so in short, where we are now is that Basel Endgame isn't off the table, but it is being re-examined. We don't know exactly when we're going to get a new proposal when a new proposal drops, we're going to be very excited. There was discussion around that being kind of late 25, but given where we are now, I'm expecting it to be more early 2026.
Yeah. Yeah, that makes great sense. Um, I guess then, Andrea, kind of turning it to your expertise, how do you see banks, large ones, regional, mid-sized ones, reacting to a lot of the evolution that Kira described? How are they thinking about approaching implementation? Like, do you see any challenges or strategies kind of overall in practice?
Yeah, I think it's helpful to frame this question in terms of explicit versus implicit regulatory requirements. So this is a lens that I often use with my clients when we're thinking through their regulatory priorities and their regulatory spend. So just to baseline on these definitions, an explicit regulatory requirement is going to be, exactly what you might expect, right? Formal, published rules, what the banks absolutely must follow, that baseline set of expectations for compliance. And a good example of explicit requirements is your direct reporting mandates. Implicit requirements are going to be more interpretive. So these are going to be requirements that need to be inferred from supervisory expectations or from guidance or from conversations with your examiners. A classic example, I think, of a implicit requirement is around data quality, data management. There isn't a statute, so to speak, that says data lineage must be done in this way, but there certainly is an expectation that a bank can show to regulators traceability from data used to populate a given line item of a regulatory report back to the source of that data. And the reason I think the duality of this implicit versus explicit requirements is especially important framing now is because we're operating in the absence of explicit requirements for Basel Endgame. So what I see with my banking clients is that they are very focused right now on the implicit side of this coin. So living up to the spirit of supervision, not just the letter of the law. And they're thinking from a practical point of view is how do they invest in work that can be considered, no regrets? What is investments that make sense agnostic of how the final Basel rules shake out? So what we see there right now in the U.S. is a lot of investment. And sorry, the room I'm in is going dark. But we see a lot of investment in data infrastructure. So I'm sure many on the phone can appreciate how painful it can be when you have data sprawl and data redundancy. So I see my clients really trying to get a grip on their regulatory data. They are looking at all the disparate data sources they have today. They're identifying what are the authorized provisioning points of my regulatory data, and they're working to source that data into one single source of truth, a cloud-based platform that can serve as their regulatory data foundation. They're also sourcing that data at an instrument grain, so they have it at the lowest level of granularity, so they have like maximum flexibility to utilize this data. And then they're partnering with companies like Suade and reg technology companies to work on having IT governed solutions that can do their regulatory calculations, that can do their last mile formatting, and that can do cross report validation, because that's also a super important element to reg compliance. So I kind of summarize it to say that what I see is most banks are using this time to build trust for their regulators, build resilience internally, get ahead of formal rules, and they certainly feel that having clean, usable, granular data is going to put them in a much stronger position, both from a regulatory readiness perspective, as well as from like an operational efficiency perspective.
Yeah. Yeah, no, that's great points. That makes total sense. And I guess with that and with what they're anticipating, Kira, I'll take this back to you. What do you expect the final publication of Basel III Endgame rules to look like or to include? How do you think are they going to differ from the 2023 proposal given the feedback? Probably. But what do we kind of expect the explicit and implicit rules to look like? You can disclaimer this with this is your estimation or your opinion too if you need.
Yeah, it's great. Thanks, Nina. And this is my personal view as a disclaimer, so thank you. But I think we're going to get a recalibrated version of the 2023 proposal. Um, it might be controversial, but I don't think there's going to be a complete rewrite. I think the framework and or the bones of that proposal are very much going to stay in place, but we'll see some of the details around it change based on the feedback that the regulators have received from the industry. I think that we'll see changes in some of the risk weighting, so especially those around residual real estate. I think that needs a collaboration, and I think we're likely to see changes there. One of the things I thought may happen is a more gradual phase in of things like the output floors to give firms more time to adapt to some of the rules, and that could soften that implementation for them. I also think we're going to get more tailoring for some of those category 3 and 4 banks, so the regional and mid-sized banks. At the moment, pulling them into the full framework, I'm not sure that feels quite right for me. In the UK, we have something called a strong and simple framework, and they have a different approach to the Basel rules. So I could potentially see something like that happen from a US perspective as well. But my honest view is that it's not going to be a complete rip up of the original proposal. I do think that the US will stay quite true to the Basel standards. Um, but I do think it's likely to be implemented in a more capital neutral manner. So global standards will try to be adhered to, but to try and keep that capital neutrality, there could also be offsets in other areas of the capital framework. And again, to pull in some comparisons, we saw the same thing happen in the UK with the removal of some supporting factors. We've then had offsetting changes made in some other areas of the capital framework, which means overall we kind of achieve capital neutrality. So perhaps we could see some of that. So a more holistic approach to the review, rather than just concentrating on some of the things that really changed. So yeah, I think we're going to get some news early next year, and let's hope I'm right because it'd be lovely to see where the movement's to. But I don't think it's going to be as drastic as we initially thought.
Yeah. No, that's interesting to hear, especially because I think with the changes in administration and the changes in the Fed, it was an idea for a bit that will it look entirely different? Will it be scrapped entirely? Will it be kind of a very similar version to what we saw in
Mhm.
2023. So I think we're
And
all
I
on
could
the
be completely wrong, and it could be
so
a
fair.
complete rewrite, but we'll
We're
see
all
if
on the edge of our seats. It's
exactly.
World Series Game 7. What's gonna happen next?
Absolutely.
All right. Well, something you said that reminded me of Andrea, something I want to ask you is with kind of cross-border banks, how do you see challenges or what do you see as the biggest challenges with these cross-border banks in managing some of the diverging Basel frameworks or the different approaches amongst different jurisdictions?
Yeah, as you'd expect for the cross-border banks, the biggest challenge is navigating that regulatory fragmentation. So where they have different jurisdictions interpreting or implementing rules in non-identical ways, that can really create a lot of operational complexity for them, can drive up the cost of compliance. And then to a point that Kira made earlier, I know at the, highest levels of banks, this is a hot topic, is could there be an uneven competitive dynamic where you may have higher capital requirements in different geographies? Um, so a lot of challenges. Earlier, when I had just spoken to the investments I'm seeing my clients making in that regulatory data foundation or incremental investments they're making to mature their data. What I described was a very US centric data foundation in full transparency. So most of my clients are focused right now on US regulatory reporting, getting the data they need to support all their US explicit and implicit regulatory requirements. But for my clients that are foreign banks or banks that operate in multiple jurisdictions, I know they have an aspiration and a North Star to eventually converge all of their data into one common single data model. So that would be to support US and any other jurisdictional regulatory reporting that they have to do. Um, as I mentioned, I haven't yet seen anyone achieve this, but there's consensus that this is kind of the best in class direction that they should head rather than being siloed by geography.
Yeah. Yeah, no, I get that. I guess another interesting question then for you would be given the US regulatory spend today and given that the US is, an environment of deregulation and proudly so often, how do you see regulatory spend allocation changing amongst American firms, especially with this kind of impending new regulation?
Yeah, it's certainly an interesting time. I started my career in banking during the financial crisis, and so to be in this moment of, to your point, in some sense, proud deregulation is a big departure from the emphasis we had seen placed on regulatory compliance for many, many years. um, I'm having a lot of really interesting conversations with my clients, especially at that executive level. There's enhanced scrutiny from them about regulatory spend from a very like pure strategy perspective. They're asking the question, if I have a finite amount of capital, which I do, then how do I justify spending $1 on regulatory that could otherwise be used to support something on their growth agenda, something with a ROI versus something that you could argue is an expense. So I think it's a great debate and an important conversation to be had. Um, that said, what I will say is, I think if you think about regulatory spend as a pure expense, then it does become hard to explain or justify regulatory spend in an era of dysregulation. But I generally think of the work that my clients are doing as investment in their data infrastructure, and that's to support regulatory use cases, but it's also to support all other kinds of use cases that can benefit from having really clean, granular, usable data. Um, I also see that my clients that are continuing to increment on these investments are way better positioned to make an acquisition in the future because they have the right infrastructure to be approved for a merger or acquisition. Whereas my clients that are just going purely based off of this is the explicit requirement I have to meet, that's where I'm going to make sure I'm compliant and kind of wait it out to see how things change. They're not maturing and less positioned to be able to make any kind of strategic M&A deal.
Yeah.
Um, I also see for some of the new market entrants, like AI native banks, they're entering with much lower technology expense than a traditional bank. So I'd say modernizing your data and your infrastructure is just important for um, general competitive purposes. So I would kind of sum it up to say that my clients that are thinking strategically see this spend not just as regulatory hygiene, but as a way to maintain their competitive advantage or improve their competitive advantage.
Nice. Nice. No, that makes sense. I guess with that and the fact that we're coming up on the half-hour mark, I think it would be a good time to bring up the polls that we prepared to kind of see where the audience feels like they stand in a couple of these things with preparedness, with kind of appetite, exposure being the first question exactly. And then while we have this pulled up and the audience answering, Kira, I'll ask you kind of one last question about having been in the EU UK markets and at Suade having implemented regulatory changes for the new Basel rules. Do you see any clear lessons or any clear kind of concepts based on these projects that could help US banks be more prepared?
So in the small amount of time I got, again, I could do a webinar on this alone.
Fair.
I would echo Andrea's comments around getting the data model set up to enable it to be a strategic advantage and also allow you to pivot easily to different rules, different interpretation. That is key. And the most successful implementations I've seen are ones where that data is aligned and ready to go. I will just also say that even though, for example, in the UK, we felt like we had loads of time to implement because there was a delay in the implementation timings, that timing comes around really quickly. So plan ahead and don't get complacent because there feels like lots of time for implementation. But also, just finally, final comment is just to stay engaged with the industry, read the different consultations that come back from different industry bodies. I think that that can then prepare you and get you really familiar with the changes that might come and how to handle them when they do.
Yeah. Yeah. That's great takeaways. And to our kind of poll answers, I think we've got quite a few attendees that potentially don't want to give away where they feel like they stand, which is so fair. But I think the most interesting here being number three, how ready do you think the US banking sector is for Basel Endgame? Underprepared being the chosen answer here. Um, I think that's somewhat fair and that's interesting to hear on this webinar, but I'm very curious to see how the new year unfolds with this. And I think I can speak for Suede and for us when we say we'll continue to do kind of webinars or at least have resources like this where we continue the conversation on where is this or how is this playing out and what does preparedness or adapting to what's coming look like. But in general, I want to thank you both for taking the time to be here.
Thank
Thank
you.
you. Thanks, Nina. Thanks,
And
Kira.
thanks to the attendees for taking part and for taking a look at this webinar today. Like I said, if you or your colleague didn't get a chance to see the entire webinar, we will have this posted so you can go back and watch. Otherwise, everyone have a lovely rest of your day. Thanks, y'all.
Thank
Thank you.
you.